Everybody, Data Day Wednesday with the Mad Scientist and Data Dean Croke. Dean, thank you so much for being here again, brother. And I should have probably had the whole intro done. I didn't know what we were talking about, y'all, this morning until about 30 seconds ago. So that's the intro.
To the HPLS podcast. Live, relevant, and high performance information, conversations, and education weekly.
I tell you, you talk about unscripted shows, eh?
Oh, I love it.
Yeah, we got a race for the top here this morning. So I think we got Lisa as the winner, Jeff coming in second, and then Daman.
Lisa's jumping back in. Come on, guys. Yeah. Daman, you got two this week. I want to see the third. Seal the deal.
Yeah. So I apologize, gentlemen. Dean, I never saw. Good morning, Antoine. I never saw the email come through. Hence the reason we got Data Day Wednesday with Dean Croke as the title. So y'all, we're going to talk about some pretty serious stuff, and I'll make sure to get that fixed for the replays. But Dean, take it away, my friend, because just in the 10 seconds I found out what we were talking about, I was like, oh yeah, let's go.
Oh yes.
Yeah. It's not a great time for reefer carriers. I mean, there are some lanes that they're doing pretty well on, right? So if you think about our national average reefer rate, so this is the line haul rate excluding fuels, at about 226. If I take out, let me add, if I talk about all-in rates, right? If I add 74 cents to that, and by the way, we still haven't had the EIA ULSD weekly average number for 2 weeks in a row now because of hardware
Why
issues.
is that? Oh,
they had a big power problem, damaged a lot of hardware. So they say, and it's the reporting's been that they on the EIA website they're saying that they still won't have the information out as of yesterday. I don't even know if it's going to be this week, which is kind of unheard of. That the fuel surcharge base hasn't been in the market for like that long, like a period where it's been absent. So the current fuel surcharge is still based on, I think it's 74 cents a mile, or the average of, what was it the week before, 5.73 a gallon. So anyway, if I add the fuel surcharge back into our line haul rate, carriers are running all-in rate carrying reefer freight at about $3 a mile. So it's been up and down around $3 a mile for quite a while, which is still not bad, right? So it's good revenue when you think about your operating costs to run a reefer are probably in the $2.10 to $2.15 range per mile. Your operating cost, fuel's going to be 88 cents a mile of that. My point is that when you go to the USDA website and look at the average rates that specific produce, fruit and vegetable haulers are making, it's closer to $4.40 a mile. So what's important about that is, of course, you've got a lot more deadhead miles to get to farms, and you've got a lot more multi-farm pickups. And that's a feature because you could, with the ag haulers exemption, you can work within a 150-mile radius and not record on-duty driving time. And of course, because farmers take advantage of that. They'll make you do stops for a carton here, 4 pallets there. I picked up produce in some of the seediest, dodgiest places. This would be a good war story, because some of the produce I've hauled was, in the middle of it wasn't produce. Let's just say, well, it was produce of a kind, but anyway, we'll talk about that on Friday during our war stories. But so produce haulers are doing well from big produce region markets like the Southeast, like Pacific Northwest, like Fresno, into major capital cities. Those guys are doing pretty well. But for the rest of the reefer carriers, rates are down this year. So the headline from this week was that during the first 3 weeks of June, refrigerated rates normally increase about 12 cents per mile. Because when you look at our trend lines year over year, there's this, they kind of get this sort of a peak towards July 4, and then they cool off and fall away. And that was very consistent from 2012 all the way through to 2020. And then, of course, everything went in a different direction. So if they normally go up 12 cents a mile in the first 3 weeks of June historically, the headline is that this year, in the first 3 weeks of June, they've gone down 12 cents a mile over the same time frame, which is really, really surprising. So there is a cooling off in demand, I suspect. There's also lower volumes being produced because 2021 was an abnormal year for volumes. It was a crazy year in a lot of respects, but the volumes coming out of the markets now are more like 2017 produce volumes. So if you think about, if the volume's about 2017, we've got 2021 volume of trucks in the market. So we've got an oversupplied market. We've just got too many trucks in the market for the level of demand. People say, oh, demand's crashing. Well, demand is more like prior non-pandemic years. Demand in refrigerated and flatbed and dry van looks a lot like it did in 2018 in many respects. But when you look at capacity, the number of trucks posting their trucks on our load boards are more like 2019 levels, which was an oversupplied bad year for carriers. So that's how the market's shaking out. This is peak shipping week for produce. All the farmers are trying to get their crop in for the best prices ahead of this weekend's shopping bonanza. I suspect we'll see rates increase a little bit this week, but I think if you remember on a show maybe 2 months ago, someone asked, what do we think produce season will look like around July 4? And I said, I think they'll level off at some point and then just sort of bounce around at that same level. There will be no material increase in reefer rates, and that's how it's kind of shaking out. But they were flat this week, which is a great sign. They certainly weren't heading south, but it was flat for all equipment types. Rates were flat across the board. So I expect we'll see a little bit of an upward trend in spot rates this week. The flip side is contract rates have peaked. So the important thing for all of our listeners is that spot rates determine the directionality of contract rates over a longer time frame. So spot rates will put a drag on contract rates, or they'll put a pull on spot rates on contract rates, depending which direction they're going. Mm-hmm. They're heading south pretty quickly. They will eventually start to drag contract rates down. The really important point is that brand new rates entering routing guides, these are new bids, new RFPs that were made in Q1 of this year. They're coming in at about 1% down than compared to last month. So they're starting to peak and come down, right? So the active rates, so all of the rates in routing guides are still going up, but at a decreasing rate because they were based on higher RFPs late last year and early this year. But the more recent RFPs that you've all been working on with your shippers are coming in with lower rates, and it's bringing the overall pool of rates in collective routing guides down slightly. So what we'll start to see is that will start to trend down. And then our expectation is towards the end of this year, early next year, you'll start to see the bottom of the cycle. And then spot rates will have bottomed out and they'll start back up again. That's what it looks like. The wild card, of course, is diesel prices and how long they'll stay at this level. It's interesting, the EIA forecast for diesel prices in Q3 is $4.78. So it's a bit less than $1 per gallon less than what it is now. So that's on the EIA website. So I'm doing some modeling now on what that looks like. That could be a welcome relief for carriers who have been paying $5.70 or even more. I've seen numbers closer to $7 on the West Coast. $6 something in the Southeast. So that's what it looks like, guys. Go out and buy plenty of produce and hot dogs. Get grilling. Help the truckers out.
Yes, exactly.
Yeah.
Now with the shift going on, can you hear?
Can you hear me now?
Yeah, we got you.
Sorry, we just had to interrupt this regularly scheduled broadcast for a Sprint commercial. So now that we got that, can you hear me now out of the way?
Can you hear me now?
We're good to go. Sorry, guys, I just had my headphones die on me as Dean was in the middle of that conversation.
Nice. No worries, dude. Now, Dean, with that shift of the contract rates, we had, I don't know if you've seen our show yesterday. We had Tony on. Tony, amazing, by the way. But he mentioned mini bids. Do you think we're going to see those start to happen then again to get a test of what's going on?
So I don't. And here's why. I think shippers are going to go back to what they've always done, which is lock you in for a long-term rate at a lower level. So, they could do mini bids on certain lanes where they've got capacity issues. That will probably continue, but I think we're going to revert back to the norm.
Yeah, I think so.
Carriers are calling shippers more so than they did. It was the other way around a year ago. Now carriers are coming back in wanting to rebid lanes and high volume lanes and offer a better rate because they're afraid of losing them. It's a normal market trend. So that's what we're hearing from our shippers, is that they're looking to do longer term bids now and lock carriers into a lower rate. So I don't know if the long term bid is dead. The RFP is probably going to make a comeback.
Yeah.
But I think the mini bid is really a function of really tight capacity and service levels. So,
Okay.
And keeping consistent with when rates are fluctuating so much.
Right.
People don't really want to get into 12 months bids, even with fuel. They want to try and capitalize on the market.
Right.
Had this conversation yesterday, and it was based on some of the things that Tony Darnell, who was on the show yesterday, talked about, where he was saying, I'll be in contract, but if the spot market drops, I'm monitoring that as well. And I want to play the best of both fields to try and recoup. And he actually let us in on kind of that back end situation at a company, and what he has to answer to and why he has to answer to it. And I thought it was a very eye-opening experience to say, okay, well, this is what these guys are really going through. Like, no BS, straight scoop. Like, guys, I spent more money than what my baseline is. And, it was interesting because you guys know me, I'm always curious about what's the baseline. Are you talking about a load you booked 2 months ago for somebody that was dying to get where you needed to go, and it was like $700 lower than market? Yeah. Where is that baseline? And he said, it's based on the contract rates that we have in place. And I thought that was awesome, because those contract rates are based on, obviously, the capacity that you set forward in your contract, and that's a great baseline for people. We've got some questions here, Dean, and I love this one from Daman. He says, Dean, would you have any cross-border info for Canada, USA? Also, there's a shortage of new trucks in Western Canada. Is this supply shortage reflected in the rates?
So, Daman, great question. I just pulled up I'm not sure how to share this link with everybody, but Dan, I'll drop the link here. I'll get the link right now for you, and I'll put it in the chat so you can post it for Daman and others.
Definitely.
So it's
interesting because you said, here we go.
There we go. He put it in the private.
Yeah. So
you put in the link to get on the show.
Okay.
But while Dean's getting that link, so Dean sent me a DM here. Outbound cross-border activity. Truckload shipping across the border from Canada to the United States fell by 30% last month, yet are still up 82% from this time last year. Equipment postings were down 10% year over year. That it says up 37, Dean. So
up 37% from April. So
37% from April.
Okay. When you see equipment postings going up, that means more carriers are posting their trucks on load boards. That means capacity is loosening. When you see load posts coming down in the spot market, that's what you mean. It means that less contract freight is falling through routing guides out into the broker 3PL spot market. So it's decreasing in that area. It doesn't necessarily mean that total volume is decreasing. It just could mean more of the volume is staying in the contract market. You've got a higher acceptance ratio. But that link that I hope we'll be able to share with you shortly, Daman, is DAT's sister company called LoadLink. DAT and LoadLink are both part of Roper Technologies on the New York Stock Exchange. And they publish a report every month on the Canadian spot market. And it talks about outbound Canada, inbound Canada, and intra-Canada. Interesting that freight activity within Canada has seen a 5% dip in April, with loads within Canada are still 45% greater than May last year. So what was Damon's question again?
So I posted the link there in all three platforms.
Yeah,
so if you guys are on YouTube, it should be in there. Facebook.
Said there's a shortage
in Western Canada.
Daman says, would you have any cross-border info U.S. Canada? Also, there's a shortage of new trucks in Western Canada. Is this supply shortage reflected in the rates?
I'll have to look at that. I'll have to take that on notice, Daman. It's a great question. I don't know. We do have rates in our system about inbound, outbound Canada, but I can't pull it up now because I'll crash the link. There's too much bandwidth going to get soaked up trying to pull that data out.
No problem. We'll get back to you on that.
Yes.
Jeff says, I think he meant to say, I agree, Dean. I have a friend who ships over 700 plus reefer loads out of Miami area in a very short period. He never sleeps there, all multi-stops. Scott, Freight Sensei, Pivot Day, great info, Dean. Thanks.
Yes, what's up, Scott?
David says, good morning. I'm joining in, laugh out loud. So, Dean, with all of this data and with what appeared, I would have thought the one thing we wouldn't have this year is an abundance of new equipment. The way they've been slowly coming off the line, like trucks were so hard, like used trucks were just so expensive over the last couple of years. I actually, and call it ignorance or whatever, I never thought that would be another kind of 2019 issue, because it's really what happened in 2019. Shippers got smarter and carriers bought a whole bunch of equipment, and it was a complete turnaround within 12 months. Yeah. And I get it, because typically these are like 5 to 6 year waves that kind of roll in through our industry. And the wave was pretty big in 2018 and people wanted to capitalize on it. Right. So what is your thoughts now for the next 6 months coming out? Are we still going to see more and more trucks hitting the market from what people have ordered, or are used equipment going to be going to the wayside to get new equipment?
Yeah, it's a great point. We could see what we saw in 2019, which is pretty high numbers of order cancellations of the orders that are already in the system.
Okay.
I mean, the reality is that OEMs and fleets are reluctant to place orders, because they don't know what the price will look like, how much impact inflation will have, what the labor market will look like. Can they get semiconductor chips, bunk heaters, all those things that are short? There's still no guarantee that they'll have them, so they can't really commit to the orders. So in some sense, that's been a good thing in terms of metering the capacity in the market. Tim Ashoff, the CEO of Crete, said on SiriusXM a while ago that he's getting about 2/3 of the trucks he'd normally order. So this is one of the mega fleets, one of the better run mega fleets in the country out of Lincoln, Nebraska. But what I heard from JD Power last month was they're starting to see inventory increase, and that means that large fleets are starting to put their trucks back into more and more back into the used truck market, because a lot of the used trucks come from larger fleets when they turn them off lease at the end of 3 years or 300,000 miles or thereabouts. And he's Chris Visser at JD Power said he's starting to see that volume increase back into the market, which is pulling down used truck prices in May in particular. So that means that there's more inventory coming back into the market, which hasn't been the case. Inventory's been very tight because large fleets have been extending their trade cycles. Trucks have been getting older. But now that's starting to reverse according to what the latest data looks like. So I think, Dan, we've already got too many trucks in the market, in particular too many smaller fleets in the market, because that's where the market's going to be hurt the most in terms of if capacity bleeds out of the industry, which it normally does in these cycles. It'll typically be the guy or girl that came in, I'm going to say, in the last 9 to 12 months into the industry, and it's all been up until February, and then it crashed. Because you've got no baseline to compare your operating costs to. It was the same in 18-19 when new entrants came in 18 and thought, wow, it's really easy to make money in this market. And then, of course, the market turned. And it's, if you don't know your operating costs in this business, your margins aren't that good at the best of times. Cash flow can really hurt you. The difference this year is two things. One is diesel's gone up $2 a gallon or thereabouts in a year. But they're coming off the most profitable year they've ever had, because diesel prices were relatively low last year and spot rates were at record highs. So what most of the pessimists in the industry don't discuss is how profitable and how cashed up carriers are. You've just got to look at some of the earnings calls coming out of Q1 for the large truckload carriers. Significant quarter-over-quarter increases in both income and revenue. I think carriers are in a really good shape to weather the storm. The caveat there is if diesel prices don't come down like the EIA forecasts to around $4.70 by Q3, that could spell disaster for a lot of people, because at 88 to 90 cents a mile, diesel is really, really high. So, if you're thinking, let's say, line haul rates are down to 197 a mile. some of the big box retailers, is that the right term? Some of the big companies that have load boards other than DAT, those rates are down around $1.75 for warehouse to warehouse moves. So if diesel's 90 cents a mile to run a truck, and you're not even getting $1.70, you're getting $1.75, doesn't leave enough, because your variable cost to run a truck are more like $1.20. So you're still going to need around $2 a mile to make a wage, pay everything, on time. And I think the carriers that have the least purchasing power in the spot market, that came in the last year, that paid a lot more for a used truck than they should have, right?
Yeah.
Or should have, so probably the misleading term. They had to pay it if they wanted to join the industry, but it's a lot more than what it would have been for many, many years. They're going to find it really, really hard, and it's the same population of drivers that came in 2018 and left in 2019. But I think it's a very nuanced subject. I know guys that have entered the market in the last 18 months and are averaging $4 a mile to this day, right? I know other guys that joined the industry power only, to haul, a lot of retail freight for the big box retailers between warehouses. They're exiting the industry in great numbers, because the margins just aren't there, because the retail side of the business has really closed down in terms of that desperation to move freight all around the country that we saw before Christmas. I don't know if we talked about on the show last week. I got where I parked my truck. There's a number. Did we talk about this story last week? You
briefly mentioned it, where you parked their truck. There's like 3 other people, and
so there's guys there,
or one sold their equipment, one released.
Yeah, so we did cover it. Or something. We did cover it. So the numbers, I think people are going to be careful with the numbers they see from the federal government, because there's this kind of misleading narrative that all owner operators are going to, go back to being leased on to a large carrier, and it doesn't make sense to me. With fuel at 88 cents a mile, why would you go back and haul freight for a larger fleet at a lower rate? You could
it be more just security, knowing that you have consistent business, not as much profit, but it's consistent?
And I mean, the caveat to that is that it could be worthwhile if their fuel discounts get you into a lower cost of fuel. So to me, we're still around break even. We're still around that margin where I could survive, because I had a great year, paid down debt, got some money in the bank. I can survive this. Remember, spot rates are still, I'll tell you exactly, dry van rates are still 26 cents a mile higher than the average of all pre-pandemic years for this time of the year. Now, operating costs have probably gone up by the same amount.
Yeah.
So I look, I'm just doing my spreadsheet again today and doing some forecasting. I could draw a lower wage and still survive this current market, even with diesel averaging $5.72 and line haul rates averaging $1.96. But I think a lot more carriers are getting savvy about the fuel surcharge. Sorry, Dan.
No, I was going to say, Dean, now, but back to your point, what about the new guys who came in almost like the 2019? You see...
I think they're going to struggle. If you paid, particularly the person that came in and paid $110,000 for that average 5-year-old sleeper tractor, with, I think the average miles was 500,000. You've got no drivetrain warranty left on that thing. And if you paid a lot of money, your lease costs are substantial. And that's going to really hurt those guys. And maybe that's part of the inventory levels that are coming back up in the auction market. Right, so I watch the auction numbers very closely from the 2 big auction houses. JD Power presents this every month in their commercial truck blog. In 2019, it hit just under 1,100 trucks. Last month, it was about 200, but it was going up from the prior month. So we've got to watch that trend very closely, because that's where those trucks go to. The other data point that's rattling around the market is this data point called Revocations, which is where a carrier's MC authority is revoked. And a revocation, you could lose it because of insurance. You don't pay your insurance, and I think it's a MCS 90 form the insurance company sends into the FMCSA, and they revoke your authority because you're no longer insured. Those numbers have been trending up. The problem with that logic is that the revocation numbers include everything from a dually hotshot guy to a box truck to a straight truck to a garbage truck to a day cab to a long haul tractor trailer. And a lot of the articles, I think, try to make the link from revocation numbers to Class 8 long-haul tractor trailers, because the government data doesn't break out, what percentage of the revocations are Class 3, 4, 5, 6, 7, 8 trucks, or does it tell us what percentage of the revocations are of the total? So it's a really difficult data set. There's no question the trend is going up. So I think there are people exiting the industry. Some of our numbers at DAT showed that there were a slight increase in carriers leaving the industry, or certainly leaving our services after about a month after diesel prices spiked. That doesn't mean they left the industry. It just means they probably couldn't afford. They were cutting costs basically, and cutting all expenses. But a lot of those came back. It's interesting in our network. For all of the drivers that leave, we're seeing as many come in with new authorities.
Exactly.
So, to me,
that's what it felt like in 2018, though, or 2019, right. End of 2018, 2019. It felt like that same thing.
Yeah, this is a tough one. I don't subscribe to all of the headlines about how bad this industry is. Remember, 90% of the freight moves on contract at the moment. It's back to about 90-10, 90 contract, 10%. Contract carriers are really, really profitable. Rates, including fuel, are at their highest levels ever. The rates shippers are paying to move freight now have never been higher. And that's because fuel has gone up so much. Because remember, the contract carriers are passing on the full fuel surcharge, whereas the spot market guys are getting an all-in that doesn't break it out. That's why they're more vulnerable. So to say the industry is in for a massive purge or bloodbath, it's incredibly misleading, because it doesn't talk about the bulk of the industry who are doing really, really well.
It only kind of references that 10% in the spot market that are struggling, or the new people.
And not all of those. It's the new guys trying to come.
DJ, it's a really small sliver of the industry, and it's the same as 2019. It's the guys that you can see them. It's a plain white truck. It's got the name on the side written sometimes.
Yes, exactly.
And if it's on there using some sort of computer, it's crooked, and it's duct taped on.
And they're not very familiar with their operating cost.
No, and it's the same group that came out in 2019.
Yeah,
came out in 18, out in 19. I've said for a long time, we've said on this show that the first ones out, the first ones in are usually the first ones out in a market cycle, because they don't have enough market cycle experience. So, it's a very nuanced subject, because within the people that are vulnerable, when they talk about owner-operators in the spot market, I know owner-operators who own 2 or 3 trucks, own them outright. They can just park them. Got no problems at all. I know a good friend of mine, it's an owner-operator that joined in January last year, adding 2 more trucks this month. Never been more profitable operating in the spot market, because this is the other thing that I think some people miss. Shippers were so desperate for capacity last year. When they had a truck come in, what do you think they saw them as? How can I lock this guy in for future work and bypass my broker? It's exactly what they did. It's exactly what they did with my friend here. He's now doing contract work, one direction, spot the other, averaging $4 a mile. So I think that it's such a fragmented industry. You can't just say that, anyone operating the spot market is going to exit the industry. That's not the case. That's far from the case. But in any industry, those that don't know their operating costs, that don't have good leveraging, are poor negotiators, they're the ones that are going to really struggle.
Interesting. Daman says truck orders are way behind, and orders are way out. I'm assuming at some point this may cause capacity shortages. What do you think about that, Dean?
Truck orders are way behind. Yes, orders are way out. Yep, they're well into next year. I mean, they haven't even opened 2023 orders books yet, because they just don't know if they can build those trucks. I'm assuming at some point this may cause capacity shortages. Gosh, I don't see it this year, because I don't see demand increasing anywhere near, the levels. We're certainly seeing, generally speaking, the same volume, maybe slightly up year over year in terms of freight volume, but we've got way too much capacity in the industry right now, so those two haven't lined up just yet. I think that could be the case next year, Daman. It's a really good question. I think next year is going to be more precarious, especially Q1, because Q1 rates normally tail off. So
and if people don't do what they need to do, now we're going into 12 to 14 months of losing money hand over fist if you didn't stack it away, right?
Yeah, we think
Damon
it'll be
also
the next,
comes back saying he's noticing more trucking companies are going up for sale. Are you noticing this? What do you think will be causing carriers to sell and get out of the market? I can share something. My neighbor had his own contract and everything, and he was an owner operator, and he actually just leased on with a big LTL Canadian company because of the volatility in the market, which is why I asked that question at the beginning. And he said, Dan, he goes, I'm making a little bit less money, but I'm home every weekend. I'm doing Toronto, Montreal runs. It's very easy. I'm doing pin to pin, go in, grab a trailer, drop a trailer, go in, grab a trailer. He goes, before he was working for a big postal company out here. And he goes, and it was like I was totally taken advantage of all the time. I was supposed to be home at 2 a.m. I only get home at 4 a.m. because they don't load me for 2 hours. And, there's 9 people standing around having smokes outside the door and nobody's working. And he says, it just, for me, that volatility is not worth the extra money. So I went with something secure. And, it's interesting. Trucking companies were getting a lot more than, because obviously they're making a lot more. Speaking to somebody else who owns a trucking company, and there was a partner that was looking to be bought out and stuff. And I said, well, is it good? And he says, well, it's inflated, right? Like we're making huge money hand over fist, and it's a very profitable market. So every company's numbers are a little inflated at this point. He goes, like, personally, I wouldn't pay it. He goes, and I'm an owner of the company, and I wouldn't pay it. So
it's interesting.
That's kind of one of the takes that I have on it. What do you guys have on that?
I think there has been a lot of people that have been very, very keen to offload their assets in the used truck market because prices were so attractive, especially surplus equipment. So that's been a feature. The other part of it, though, that Damon's alluding to here is the need for companies that are adjacent to the truckload sector to lock in capacity, to add more to their offering. You've seen shipping lines buy air freight companies. You've seen, so I think a lot of folks have said, how do we secure more of our supply chain? It's a bit like a lot of truckload carriers are buying final mile fleets.
I'm noticing a lot of brokers starting to become customs brokers as well, offering that in-house customs clearance, right?
So I think part of that merger and acquisition piece that Damon's alluding to is that these are probably the numbers look pretty good to get out of the business. But I think that part of it is people have been looking to have more control of the supply chain for their customers. But he's right. I think there'll be a lot more mergers and acquisitions. Of course, one of our biggest, your biggest, Dan, Canadian companies, our good friend Dan Einwichter at Challenger Motor Freight, sold their fleet this week to, can't think of the name.
Fast Freight, wasn't it?
Fast Freight, yeah.
Did you see there's another big one, US Truck or something?
USA Truck from Van Buren, Arkansas. Yeah, it was acquired by
Schenker, DB Schenker.
DB Schenker. So that's a great example of what we're talking about. I should have ran with that one first.
Yeah, they did 435 mil on that deal, I think.
Yeah. So I think that's part of the answer for Damon. I think there'll be a lot of mergers and acquisitions in the bigger fleets.
I was actually really surprised with Challenger.
Yeah, I'm not, if you know Dan. I think I'm really happy for him from starting off out of college with one truck.
His story is absolutely astronomical. I mean, it's a crazy story. But I just thought, I know how much he loves the industry, and it was just to me, it was a surprise, and then I guess it wasn't, because again, companies are going to get a solid dollar for their more now. That it's just like the housing sales, right? Housing market in my area is kind of plateaued, and houses are staying on the market longer. But if you go back 8-10 months ago, houses in my area were on the market for 2 days. and people were getting $250,000 over asking. Right, like it was just a really good market for it, and I think the same thing came in trucking. Daman has another very important point. He says,
I was going to say,
important as the rise in fuel prices, it's important to take into consideration the rise of wages across all industries, including trucking, due to inflation, labor shortages. Fuel plus labor is always a top 2 cost for trucking companies. And Dean, that goes back to, you're an owner operator, so you're making a wage, but if you're a fleet company and you have a driver, your driver wages have increased. A lot of drivers are actually going to salary now as opposed to per mile.
Right.
And then your cost increase to get your truck serviced, your cost increases for your fuel, your tires, everything that goes on the truck. And all these costs have risen and the rates are dropping.
So on the spot market, yes, contract rates aren't dropping.
That's right.
So remember, if you're locked into good long-term contract rates, they will come under pressure eventually, for sure, when contract rates start to decrease, because you can't claw back those driver pay increases. It's the same in 2019, right? Everyone went through that wage increase period, and then all of our operating costs started to hurt in 2019. Same thing now. So he's exactly right.
Yeah.
I think it'll come a little bit later in the year for larger fleets who probably have a little bit too much exposure to the spot market. It's certainly the case in flatbed. There's a lot of large fleets that dabble in the spot market as it relates to flatbed, because flatbed rates are really attractive compared to dry van and reefer.
I was going to say, how are flatbed? Are they still pretty elevated compared to?
Yeah, flatbed line haul rates in flatbed have been averaging. This is a really weird number, but flatbed rates were averaging 258, so 2.58. I'll add 80 cents. Their fuel surcharge is usually higher for flatbed. So their average is 338, DJ. So flatbed have been averaging 338 including fuel, 260 excluding fuel. But here's the important point. They've been averaging that for 13 months.
Yeah.
So
they never shifted.
And the other part, though, is there's a lot more freight moves in spot in the flatbed market than reefer and dry van, by about double. And the reason is it's a lot of project freights, a lot of one-off freight, a lot of construction sites. There's no predetermined rates in routing guides, a lot of deadhead miles, a lot of accessorials, a lot of cranes, a lot of extra equipment you've got to have on your flatbed, especially when you get into drop decks and extended trailers. So when you think about that, flatbed line haul rates, excluding fuel, are about 60 cents a mile higher than dry van right now. So if you're a carrier and you've got a lazy flatbed laying around, I know guys that have just dropped their van and they're under their flatbed. I think a lot of people miss the point that a lot of our seasoned owner operators have more than one trailer parked around behind the barn. So these are pretty savvy operators. They know how to run a business. That's the backbone of this country, are the guys that have been in it, seen a few cycles, own their own truck. They're steady up and down the road. They're not breaking any records. They really know their operating costs, and they're very versatile. And then at the periphery of that, you've got the new guys that come in and leave, and at the other end, you've got people looking to bail out and sell to a larger company because they've earned it.
Yeah. Scott says, I can almost imagine that there are a lot of new brokers in the market that have the same operational mindset, trying to start their business off with transactional freight, trying to survive off that 10% spot opportunity. I see this, and it's interesting. I've had more conversations over the last probably 2 months with companies that are actually agents for another company, and then they use that other company's financing to grow their business, and then they move into their own company. So instead of doing like lines of credit from the bank and stuff, they'll use an agency, and I'll call it Landstar for hypothetical reasons. So they go in and they start like a company as an agent of Landstar. They build their business, they get their relationships, they build those relationships, then they start ABC Brokerage. The transition seems to be shifting, and over the last 2-3 months, we're probably upwards of close to 30 companies that I've spoken to, and for the past couple of years, I've never heard of that.
Wow.
So it's an interesting way to go and start a company with somebody else's money. right? Very interesting way to do it, because you're building up those relationships, and eventually you're like, okay, well, I am an agent, so I can leave. And you leave, and now you've got your own company, you got your contacts, you got you got your carriers, you got everybody, and it's an easier transition. Because I've met a couple of people through my training course that said, I want to become a broker. I'm like, okay, what do you know about trucking? They're like, absolutely nothing, but I want to become a broker. And like, you can spend a lot of money really quick, because one of my first things that I say is, your biggest issue is going to be cash flow, because carriers are not giving credit out easily anymore, and they don't want to be stung, So
on that subject, I heard on Landline this week, and I'll be on Landline tonight at 7 p.m. Eastern. It's a shameless plug. On Sirius
7 p.m. guys. 7 p.m. Don't miss
Eastern, everybody. Catch Dean on Landline.
Landline. Check him out.
I'll be pumping up sales chatter tires. Don't you worry. What Marty Ellis said on Landline earlier this week was really interesting, and he said he's the first one to note that not all brokers are bad, but he's heard of, on more than one occasion, of brokers changing the rate when the truck's at the loading dock.
What?
Whoa, no,
that's
bullshit.
That's awful. I mean, talk about having no leverage. You get a phone call to say, "Hey, yeah, the rates dropped," and you think, "Well, what am I going to do? Like, I'm on the dock." This is what really drives people insane in the industry, and why a lot of owner-operators, small fleets, get so antsy about brokers, because your reputation generally in the broking world, from a carrier's perspective, you're only as good as the last time you were shafted, right? And that not by you, but by anybody, right? Because everybody gets lumped in, and it's the same with carriers. A lot of folks lump carriers into the same bucket. If they drop a load, turn down a load, late for a load, damage freight, it works both ways, but that's not a good situation at the moment. I've not heard of that happening before, but obviously it has.
Damon says Dan had an amazing journey. Remember, he didn't sell all of Challenger. It was only a percentage. Plus, Fast Freight is a very progressive and have been pushing to expand over the past couple of years. It's a good partnership they formed. Interesting. I didn't realize he only sold a portion of Challenger. I thought he sold it.
Right. That's what I thought too. Good to know. Thanks for correcting us on that, Damon.
So, Dean, what are some of the big things you're tracking this week that we can expect to talk about in the coming weeks?
Yeah, we'll be doing a complete wrap-up on produce season. That's the big thing that we're looking at right now, is how the year pans out towards the end. We're seeing volumes are pretty low.
Jeff. That's bullshit, Dean. That's the best way to destroy your relationship. I mean, hey, listen, if you're a carrier and you're on the dock and they change the rate, never take freight from that person again. I don't.
Oh my gosh!
Don't do it. And I know, there's always that. Yeah, but if they have a load and I need to get there and I just take it for fuel, at least I'm not losing as much.
Yeah, but the problem is that's how the situations happen. Like with Jeff with Landstar and him having that situation. I've had that with many companies I worked for. Oh, we can't take Landstar. We can't. Like what? Yeah. I have this great guy at Landstar. I'm using them. No, but
for everybody watching, just to add context to it, DJ, Jeff was talking to a customer and pretty much like landed the deal. It was done.
Yeah,
and then they realized that his company was a Landstar agent, and this person had the person higher up than the person Jeff was talking to had a huge issue with Landstar and completely lost the deal over what somebody else like that, did. Though. Which was bullshit.
Damon's got a good point there.
This was one thing I was actually going to bring to Damon. Thank you. On yesterday's show's Tony comment was he was stung by brokers 10-1. Yeah. I'm assuming your story has some truth in it. Of course, yes, for sure. And it was so two things that Tony said: 80-20. The ideal or the unwritten rule is 80% broker, or 80% carrier, 20% broker in a company, right? I was very intrigued by that. Then he was 10-1 on brokers letting him down, which I was actually blown away with, because I know there's crappy brokers out there, right? That's why shows like this exist. But I was not aware there was that many.
Oh, there is
10-1.
It's like I don't even want to get into it. I'll start ranting, but
as an intermediary salesperson, think about that obstacle, that brick wall you're up against before the phone even rings. Like before your prospect even answers the phone, you're a 10 to 1. If that's like what most people experience. And if you're shippers out there, please get a hold of us, DM us. We'd love to know what that number is for you, because like 10 to 1, like at that point, I would never deal with brokers. I'd find a way to deal directly with carriers. But
I think that's the issue.
but DJ, there's also the other side of that, right? Is there's multi-billion-dollar companies that only deal with brokers.
Right.
Because it's easier for them. They have the right, again, it's the right people, right? It's not the logo. It's nothing. It's the right people. If that broker, your person you deal with, your team, your partner truly cares about your results, you'll typically have a good experience. 10 to 1, like that number's insane. Every 10 loads, 1 actually picks up and doesn't get given back. Like how long would you go dealing with that before you'd say cut that snake off at the head?
Yeah.
Well, every trucker's got a 4-letter word list, and you don't want to be on it if you're a broker, right? Because carriers have pretty good memories. So I think they look to. We've seen a lot of carriers build very good relationships with brokers in their preferred networks. They've done exceptionally well. So, I think it's like everything. I see some awful carriers out there. Their behaviour is just terrible on the roads, and I suspect it's the same in every single industry.
Yep.
And of course, maybe that's just a function of human nature. But if I could,
humanity, right?
if I could segue back to your question and answer what we're looking at. I'm really anxious to see by this time next week, what produce volumes really look like for the peak season this week, where rates ended up. And then the transition happens into some markets like the Pacific Northwest, because temperature's warming, produce season moves further north. We're starting to see some produce volumes come out of the Pacific Northwest after a slow start to the season. Rates have started to increase slightly out of markets like Pendleton, the Yakima Valley. That's the big market for a lot of carriers that run the I-5 up to Seattle and Portland, and then look to come back south into Los Angeles or to Phoenix and Dallas. So that market is starting to come alive, but it's not going to save a lot of produce carriers, because on some of the lanes, and I'll quote you a couple of statistics this week, Laredo to Hunts Point, like a lot of so we're past the Mexican import season. Laredo to Hunts Point down $1.30 a mile compared to this time last year. But trending down again already. Fresno to Chicago, another big lane for reefer carriers, averaging 206. It's almost $1 per mile lower than this time last year. Remember, California's had a lot of drought problems, very slow start to the season. Volumes aren't really good. Fresno to Chicago, Fresno to Hunts Point. Fresno to Hunts Point's a pretty big one for a lot of cross-country teams. Line haul rates are 5 cents a mile lower than the May average, which is really unusual for June. Normally things are increasing, but they're also just over $1.30 a mile lower than this time last year. So a lot of those key lanes that carriers run, refrigerated produce in particular, normally they'd be going up, are way down year over year, and not moving the needle at all. So normally this is a quarter when carriers make pretty good money. Produce season generally provides a big boost, and then rates start to cool off. So I'll be very anxious to watch this transition next week. There is some discussion that produce season could run a little bit longer because it was off to a slower start. Problem is everybody goes on holidays. We don't have any big party type weekend events to really draw significant volumes into the market. So hence my comment earlier, get out there and buy hot dogs, burgers, strawberries, get at it, people. help your local.
Have fun on the 4th. Have fun on the 4th.
Yeah, get together, get there and do
lots of food and lots of fruit. But Dean, with the trends and the data what we're seeing right now, what does it look like, or what would be your guess for the holiday season then?
I think rates are going to cool right off after July 4, as they do always, because demand does fall off. I do see some volatility in markets around ports because there is import volume coming in. Problem is we've got warehouses just chock full of freight. I don't know if you read the NBC story this week. The president of Walmart said that they've got, and I'll quote you the number. It was kind of a bit of a jaw-dropping number when he said that the article said that Macy's, Target, Walmart, and other big retailers have inventory levels that were up anywhere between 17 and 45% this last quarter compared to quarter last year. The more amazing statistic was John Furner, CEO and president of Walmart, said there's probably 20% of inventory. If you could just wish it away and make it disappear, you would.
Wow.
So I think we're in.
20%.
Amazon Prime Day. I've got 2 days coming up. I think we'll be in for a bit of a retail shopping bonanza.
Yeah.
And there'll be some pretty good sales coming up. So I think there's an excess of inventory people need to move. They need to move it to make way for back to school and holiday season inventory. So we need to get that happening. That inventory is going to come in. Remains to be seen whether that moves the needle nationally in the truckload space. I don't think it will. It will at ports. It will at certain ports where they've got surging volumes, because of.
And it will, for certain areas, increase warehousing. I can tell you, Canadian Tire has been reaching out like a madman up here, trying to get every single stitch of warehouse space because they're already looking at winter stuff coming in.
Exactly.
Got nowhere to put it. The big box items like the gazebos and stuff that aren't selling. They're like, get it out of here. We got to get it out of the building. We got to. It's turning that whole warehouse side of it on its head again. It's crazy. Dean. Speaking of the data, and I don't know if you pulled it up, but one thing that seems to have fallen off is an update on Shanghai and what's going on and kind of where we're at with containers.
Good point.
We had a bunch and kind of ETAs to the ports in the U.S. because that's going to cause another ripple when all these ships starts hitting.
Right. It's clear from all the people I talk to, like some of the people that track, they're back to normal in terms of ship volume and ship velocity.
Now, when you say normal, pre-pandemic normal or pandemic normal?
No.
Good question. I don't know the time frame.
What normal are we talking about?
Yeah, because there's a couple of normals.
It's terrible. We even have to ask that question.
Well, so when you think about it, it's pre-pandemic normal was just like total insanity, but we're hearing very little of it in the media. And
yeah, right? Jeff. Also, Jeff. Any word from you, Jeff? Because Jeff, you
only 21 vessels at anchor off Long Beach and Los Angeles. So there's very little vessel bunching on the West Coast. I'm looking at the volume port optimizer from the Port of Los Angeles. Volumes this week are up 15% compared to last year. Volume next week will be up 42% compared to last year at 126,000. And then it'll drop off to about 16% below. So there's more volume coming in year over year based on the vessels that have containers on the ocean right now for the next 2 weeks, it looks like.
And that could be because companies are still pre-ordering in advance as opposed to waiting and that kind of thing.
Right. And some of those, we're 3 to 4 weeks away from when I think vessels started to move out of Shanghai and the Asia region. Mm-hmm. So I think that could be part of it. How about Savannah and Houston? I don't.
Yeah, good question. Good question.
But so that's a good point because those volumes are up year over year. I won't have that data, Jeff, until late next week when the peers data updates from all the bills of lading that came in June. But maybe I don't know. I'll have it for next week's show, but I'll take that question on notice. If I can get it in for next week's show, we'll talk about import volumes.
Yeah, perfect. That's
right.
Awesome.
So I think DJ asked the question. Rates are going to probably trend down more than anything until after July 4. There's generally a bit of an uptick around Thanksgiving. You always see a little bit of a bump, especially reefer carriers 3 to 4 weeks out when all the fresh turkeys start moving. And then it depends on how busy the holiday season is. There'll be an increase then. They'll drop off a little bit after Thanksgiving, then they'll increase towards, December 25, and then they'll cool right off again. So I think Q1 next year is when we start to see rates bottom out in this freight cycle. That's the general expectation, and then we're sort of off to the races again.
Okay. Nice. Awesome. Great show, gentlemen. Right. Great show. Tons of data for all y'all watching and listening. Get ahead of it right
hopefully that was informative for y'all.
Mm-hmm.
Yeah. Thank you.
What do you got to take us out today, DJ?
All right. Well, hey, thank you again, as always, Dean, for making these shows. They got to, with everybody on here, they got to be one of the most popular shows, at least on Wednesday, because of Dean. So thank you to Dean and Dat for
for joining us every week.
the information, the stuff you get. If you aren't watching Dad on Tuesday and you're not watching this show today, you're crazy. And you're in this industry, you're crazy. So you got to
That's a good call. Good shout out there, DJ.
I'm sorry. It's true. It's true.
It's true.
You just watch those two shows. You'll have so much information to bring to your clients, customers, and know what the hell's going on. And that's
I think anyone that's in it for the real long run, it should be a staple. 100%. Like if you're in it to truly make a career out of this, Tuesday and Wednesdays are some of your biggest days in the industry to listen to what's happening and what's going on. And not only that, one thing that happened a little more today that tends to not happen all the time is people are absorbing the information. Mm-hmm. If you're unclear about anything, ask the question. Because if you're unclear about it, there might be other people that are unclear about it. And DJ and I might be clear about it, so we're not going to ask, but ask the question. Daman threw out a huge amount of questions today. They were awesome.
Yes.
So did Jeff.
Thank you for
These
all the
people
questions.
are industry veterans, but they're still saying, hey, what do you think about this? What's this? Because it gets them ahead of that shift, that change curve even more. So don't be afraid to ask the questions. Don't be afraid to ask anything to Dean, because he's a mountain of knowledge that can help you with a drop of a dime.
Yes, agree. Jeff has a few great things.
Yeah, so Jeff said, please look into shipper. If shippers are skittish and moving from LA or Long Beach to the other locations, he's curious.
Yeah.
And then Scott says, great info today. Thanks, gents. Thank you,
Scott.
Go on, brother.
Again, thank you, everybody, for joining us as you do weekly. Sales Chatter Live, Monday through Friday, 9 a.m., 9:30 Eastern Standard Time, except Triple D days, 9 a.m. till 10 a.m. Again, start your day right with us. Get your mind right, get your game right, and get ready to design the career that you want and the future that you want. Thank you to American Logistics Centurion Trucking for making this show possible. Daman, man, shout out to you for all the questions today. And this is just what I went with for today. The wise man said, do not take revenge. The rotten fruits will fall by themselves.
Yes, exactly.
That's interesting. When we start talking about 10-1 odds and things going down. Yeah, there you go, everyone. Centurion Trucking. Our motto is people before profit. Today's market requires more transparency, consistency, and focus on what our clients need to win. Centurion Trucking and American Logistics are poised to help their clients achieve and surpass their targets. If you're looking for a team that honors your needs, dreams, and aspirations, then get a hold of Daman at American Logistics or Centurion